Good morning. The math ran last night. Here is what changed, and how historically similar conditions have evolved. The regime this morning is stagflation mild, with a confirmation score of 18 out of 19 series aligned. That is a strong mathematical signal. Overnight, the VIX closed at 21.41, positioning at the 82.2 NN percentile of its two-year distribution. That means equity volatility is elevated, sitting well above its historical average. This matters because stagflation regimes typically feature asymmetric volatility, fear in equities, relative calm in bonds. That dynamic is mathematically present right now. Let me walk through three core signals. First indicator, the Bank of America High Yield OAS Composite, BAML 0 A0 WHIM2, currently shows green momentum. The exact definition, returns above the 60th percentile of the trailing 12-month distribution. In 7 of 9 historical instances when high-yield momentum aligned green inside a stagflation regime, credit spreads either persisted at those levels or compressed further within 30 trading days. Second signal, core inflation ex food and energy, CPIL-FESL. This series carries green momentum, defined as year-over-year acceleration above its 90-day moving average, combined with percentile rank above the 65th level. In 8 of 11 historical instances when this inflation component showed that pattern inside stagflation, the regime persistence extended 60 or more trading days. Third signal, non-farm payrolls, PAYMs. Employment growth displays red momentum, defined as monthly changes falling below the 40th percentile of the rolling 24-month distribution. In 10 of 12 historical instances when payroll momentum weakened inside a stagflation regime transitions followed, meaning the regime changed, within 45 to 120 trading days. Now the regime framework. The current regime is stagflation mild. Confirmation score, 18 of 19 series aligned. That alignment is statistically strong. Historical persistence, 52% of 11 observed instances with similar alignment strength persisted for 3 or more months. The most common transition from here, historically, was acceleration, observed in 28% of instances. That means expansion combined with accelerating inflation. Today's data reinforces the regime. Equity volatility elevated at the 82nd percentile, bond volatility calm at the 23rd percentile, credit spreads resilient, crude oil up 5.05%, gold near 4,769. The math is observing a regime under pressure but not yet breaking. 2. If-then triggers are now mathematically active. If the 10-year Treasury yield crosses 4.45% and holds that level for 5 consecutive trading sessions, inflation composite indicators historically showed acceleration in 9 of 11 similar instances. That would increase the mathematical case for a transition toward acceleration. If fear and greed index drops below 15 and maintains that reading for 5 consecutive sessions, confirmation score deterioration historically occurred in 7 of 9 instances. That would formally lower regime confidence and trigger a watch flag. The math identified conditions across 19 distinct data series this week. That pattern exists, but that is a different conversation. These are historical mathematical observations, not predictions and not advice. Given Analytics is not a registered investment advisor. Hypothetical results may vary from actual results. Market conditions can change at any time. May potential educational. This is Given Analytics. GivenAnalytics.com.